welcome to the Property Wealth Podcast. I'm so glad you could join us today.
Yeah, I'm really excited about this one, Sarah. 1031 exchanges can be a great tool for real estate investors, but there are definitely some pitfalls to watch out for.
Absolutely. It's like one misstep can really derail your entire investment strategy, right?
Exactly. So today, we're diving into some common mistakes people make with 1031 exchanges and how to avoid them.
And we'll also cover why understanding the timeline is crucial, what properties qualify, and how to navigate the complexities of the whole process.
Plus, we'll share some real-life examples that'll really bring these concepts to life.
Yeah, I love that. It's one thing to read about these strategies, but hearing how they play out in the real world makes all the difference.
For sure. And for anyone over 40, this can be a pivotal time to think about how to maximize your investments for long-term wealth.
So let's get into it, shall we? Let's start by breaking down what a 1031 exchange is and why it's such a powerful tool for real estate investors.
Sarah, when we talk about the 1031 exchange, it's really not just a tax strategy. It's about the bigger picture of financial security, especially for people over 40.
Absolutely, Mike. I think a lot of folks in that age group are starting to think about retirement, right? It's like the clock is ticking and they want to make sure their investments are not just secure, but also growing.
Exactly. And with inflation the way it is these days, it's crucial to have that hedge against rising costs. Real estate tends to hold its value well over time, and the 1031 exchange lets you defer those capital gains taxes, which can really make a difference in your portfolio.
Right. So instead of cashing out and getting hit with those taxes, you can roll that money into another property, potentially a more lucrative one. I've heard stories of investors who did just that and ended up doubling or even tripling their wealth in just a few years.
Yes, I remember one investor, let's call him John. He was in his late 50s, had a couple of rental properties, but he was feeling the pinch of those tax implications. He decided to do a 1031 exchange, sold a smaller property, and moved into a multifamily unit.
That's smart. So he not only avoided the tax hit, but he also increased his cash flow?
Exactly, and you could see the relief on his face. He was worried about retirement, and suddenly he had this new income stream that made him feel more secure.
It's such a game changer, isn't it? But I think the emotional side of investing is often overlooked. For many people, it's about peace of mind, knowing that they're building something for their future and their family.
For sure. And think about wealth transfer. Many people over 40 start considering how to pass on their assets to their kids or grandkids. Real estate can be a fantastic way to do that, especially when you leverage the 1031 exchange.
Right, because if you can keep that wealth growing, it benefits the next generation too. I've heard of families who've used the 1031 exchange to turn a single property into a whole portfolio that their kids can inherit.
Yes, and that's so powerful. You're not just thinking about your retirement anymore. You're thinking about a legacy. But, it's not without its challenges.
Oh, absolutely. I've also heard stories about people who tried to do a 1031 exchange and, they missed some key deadlines or didn't follow the rules properly.
Right, and that can lead to some serious financial repercussions. It's essential to be aware of the timeline, like the 45-day identification period. That can really trip people up.
Yeah, I can see how that would happen. So if someone isn't fully prepared, they might end up losing out on a great opportunity, which would be devastating.
Definitely. I had a client named Lisa who was so eager to make the move. She had a strong plan, but didn't account for the time it would take to find a suitable replacement property. And she ended up missing that 45-day window.
Oh no, that's tough. So she had to pay those capital gains taxes after all?
Yes, and it was a tough lesson for her. But it's why we emphasize being organized and having a solid plan in place. You can't rush this process.
It really highlights the importance of education and preparation. I think that's something many people might overlook when they first hear about the 1031 exchange. They see it as a quick way to avoid taxes without realizing the nuances involved.
Exactly. And there's also the emotional aspect you mentioned earlier. When you're investing in real estate, you're often tied to those properties. It's not just about numbers. It's about the memories and experiences they hold.
Right. So it can be tough to part with a property, especially if it's been in the family for a long time. But if you can see the bigger picture, like using the 1031 exchange to upgrade, it can really help.
Yes, and sometimes that's where having a trusted advisor comes in. They can help you navigate those emotional hurdles while keeping your best financial interests in mind.
It's like having a coach, right? Someone who can help you stay focused on your long-term goals, even when emotions get in the way.
Absolutely. And in today's market, with shifts happening all the time, it's more important than ever to be strategic. You want your investments to be resilient and adaptable.
And that's what makes the 1031 exchange particularly relevant right now. It's a way to reposition your assets in a changing market while still building that long-term wealth.
Exactly. And as we move into the next segment, we'll dive deeper into some core strategies that can help you avoid common pitfalls and make the most of the 1031 exchange. This is where it gets really practical. So let's dive into some core strategies and rules of thumb when it comes to a 1031 exchange, because these can really make or break your experience.
Absolutely, Mike. I think starting with the basics is key. What's one of the first things you'd recommend investors keep in mind?
Well, one simple rule is the asterisk 1% rule times. It's a good starting point to evaluate rental properties. Basically, you want to aim for a monthly rent that's about 1% of the property's purchase price. So if you buy a property for $200,000, you should ideally be looking for at least $2,000 in monthly rent.
That makes sense. So if a property isn't meeting that threshold, it might not be worth pursuing.
Exactly. You want to ensure that your investment is cash flow positive. If the rent is significantly lower than that, it could indicate underlying issues, or that the property might not be in a desirable area.
Right, and I guess that leads us into evaluating the market. What's your take on that?
Market evaluation is crucial. You'll want to look at asterisk cap rates nomies, which is essentially the return on investment for rental properties. The formula is pretty straightforward. Divide the annual net operating income by the property's purchase price.
So if you have a property generating $20,000 a year in income and you bought it for $200,000, your cap rate would be?
Well, that would be $20,000 divided by $200,000, which gives you a cap rate of 10%. That's a solid return.
Yeah, definitely. And a higher cap rate generally indicates a better investment, right?
Exactly. But keep in mind, cap rates vary by market. In some areas, a 5% cap rate might be considered great, while in others, you might be looking for something closer to 8% or 9%.
Interesting. So it's about knowing your local market and what's typical there.
Spot on. And then there's the asterisk 50% rule time docs. This is another handy guideline. It suggests that about 50% of your gross rental income will go towards expenses, not including the mortgage.
So if you're grossing $2,000 a month, you should expect about $1,000 to go towards expenses?
Exactly. This gives you a rough estimate to calculate your cash flow. If the numbers don't work out, it's time to reconsider the property.
That reminds me, let's talk about financing options. What do you think are the best approaches for someone looking to do a 1031 exchange?
Well, conventional loans are always a solid choice, but you might also consider private money or hard money lenders, especially if you're looking at quick flips or properties needing renovations.
Right. Those can be a bit riskier though, right?
Sure, but if you have a solid plan and know how to manage the risks, they can also provide a great return. Just make sure you're aware of the terms and the interest rates, as they can be higher than traditional loans.
And what about the type of properties? Are there specific types that you think work better for a 1031 exchange?
It really depends on your goals. Residential properties tend to be more stable and easier to finance. But if you're looking for higher returns, commercial properties can be a great option, albeit with more risk.
So someone might want to diversify their portfolio with both types, right?
Exactly. It's about balancing risk and reward. And don't forget about the location. Properties in growing markets can appreciate significantly faster.
Yeah, and it's important to look at trends, right? Like, is the area developing? Are jobs coming in?
Right. You want to research local economic indicators. Job growth, population growth, and even infrastructure developments can give you insight into future appreciation.
Now, what about a checklist for evaluating potential properties?
Great idea. I usually suggest starting with a simple checklist. 1. Maj-lumpler Maj equation risk. Is it in a desirable area? 2. Property condition, NIMES asterisk dash. What's the maintenance history? 3. NIMES current rental income, DIMES asterisk. Does it meet the 1% rule? 4. Expenses asterisk. Can you estimate them accurately? 5. Cap rate 6 dash. Does it align with your investment goals? 6. Market trends asterisk edge. Is the area appreciating?
That's super useful. It seems like having a clear checklist can help streamline the decision-making process.
Absolutely. It takes the guesswork out and keeps you focused on your investment criteria.
And once you find a potential property, what's next?
Well, that's where the due diligence comes in. You'll want to do a thorough inspection, check local regulations, and even talk to current tenants if possible.
Yeah, understanding tenant satisfaction can be a huge factor, can't it?
For sure. Happy tenants often lead to lower turnover rates, which means less hassle for you.
Okay, so we've covered a lot of solid strategies, but what about common pitfalls? I think that's something our listeners would want to avoid.
Absolutely. One big mistake is not having a backup plan. The market can shift, and if your first choice falls through, you want to be prepared.
That's a good point. Flexibility is key, right?
Definitely. And don't forget about the timeline for the 1031 exchange itself. You have strict deadlines to follow. 45 days to identify a property and 180 days to close on it.
Wow, that's not a lot of time.
Exactly, and many investors underestimate how quickly they need to act. It can lead to rushed decisions.
Yeah, and that can be dangerous.
For sure. And another pitfall is not accounting for all the hidden costs, like closing costs, repairs, and property management fees. It's easy to overlook those when you're excited about the investment.
Great reminders, Mike. It's all about keeping your eyes open and having a solid game plan, isn't it?
Exactly, Sarah. With the right strategies and awareness of the pitfalls, you can navigate a 1031 exchange successfully and build that long-term wealth.
Well, I think we've covered some fantastic ground here. Let's wrap this section up and transition into those common pitfalls we mentioned.
So, Sarah, one of the biggest pitfalls I see with 1031 exchanges is over-leveraging. You know, investors often think they can just dive into the deep end without really assessing their financial situation.
Right. I mean, it can be really tempting. You sell a property, you've got this influx of cash, and you want to maximize your gains. But then you end up stretching yourself too thin.
Exactly. I had a client once who sold a multifamily property and rolled all the proceeds into a much larger property. He was really excited about the potential cash flow, but he didn't account for the increased expenses.
Oh no, what happened?
Well, he ended up with a significant mortgage payment. And then, suddenly, he had unexpected maintenance costs and some vacancies. It was like a perfect storm. His cash flow was negative before he even knew it.
That's brutal. So how can investors avoid that kind of trap?
It's all about doing your homework. You want to make sure you have a solid understanding of your cash flow before you leap. Look at your new property's expenses and keep some reserves for those unexpected costs.
And speaking of unexpected things, bad tenants can really derail a good investment, can't they?
Oh, absolutely. You might think that a property in a good neighborhood will attract great tenants, but you can't always judge a book by its cover.
Right. I remember you mentioning a situation where a client got into trouble with tenants.
Yes, this one investor bought a lovely property, and on paper, everything looked great. But they didn't screen their tenants properly. They ended up with a group that didn't pay rent on time, and it took months to get them out.
Wow, that's a nightmare.
It is. And in that time, they not only lost rental income, but also had to deal with legal fees and repairs. It really added up.
So what's the best way to avoid that situation?
You've got to be diligent about tenant screening. Check references, run credit checks, and don't skip the background checks. It's definitely worth the effort to find reliable tenants.
That makes a lot of sense. And what about cash flow? I know a lot of investors can get swept up in the excitement and forget to focus on the numbers.
Yeah, cash flow is the lifeblood of any property investment. I had another client who bought a property that looked good on paper, but when the numbers were crunched, the rental income barely covered the mortgage.
Yikes, that's a red flag right there.
Right? And they had to start dipping into their savings to keep the property afloat. Cash flow analysis is crucial. You should always take a close look at the rental market and projected income before making a decision.
Definitely. And timing the market seems to be another common mistake, doesn't it?
For sure. A lot of investors wait for the perfect moment to buy, thinking they can time the market like a pro. But the truth is, waiting can often lead to missed opportunities.
I've heard stories where people waited too long and ended up paying even more later on.
Exactly. I had someone who sold a property thinking prices would drop. They ended up waiting a year, and when they finally decided to buy again, prices had skyrocketed.
That's a tough lesson. So, what's your advice for those who feel stuck waiting for the right moment?
It's about focusing on your investment strategy rather than market timing. If you find a property that fits your long-term goals and the numbers work, go for it. Waiting can lead to regrets down the line.
And then there are those hidden costs that can sneak up on you.
Yes, hidden costs can be a real killer. Things like property taxes, insurance, and maintenance can be overlooked.
I remember you telling me about an investor who didn't account for property taxes properly.
Yeah, this investor bought a nice property in an up-and-coming area, but they didn't realize the property taxes would increase significantly after the purchase.
Ouch.
Right? They ended up with a much higher bill than they had budgeted for, which ate into their cash flow. It's vital to do your due diligence and factor in those potential costs before making a move.
So how do you spot these red flags early?
Great question. One way is to ask lots of questions during the purchasing process. Look for patterns in the financials. If the cash flow seems too good to be true, dig deeper.
And I guess it's also about working with the right professionals.
Absolutely. Having a good real estate advisor, a knowledgeable accountant, and a solid property manager can make all the difference. They can help you navigate through the complexities and avoid common pitfalls.
It sounds like a team effort, for sure.
It really is. And remember, if you do make mistakes, it's not the end of the world. You can always recover.
Exactly. So if someone finds themselves in a tough spot after making one of these common mistakes, what steps should they take?
Well, first, assess the situation. Look at your finances and see where you can cut costs or rearrange your budget.
And reaching out for help is important too, right?
Definitely. Whether it's consulting with a financial advisor or a real estate professional, getting a fresh perspective can be invaluable.
It sounds like proactive steps can really help turn things around.
For sure. And remember, every investor makes mistakes at some point. It's all about learning from them and moving forward with more knowledge and experience.
Wise words, Mike. Thanks for sharing all these insights. I'm sure our listeners will find them super helpful.
All right. So let's dive into some immediate steps that our listeners can take today.
Yeah, absolutely. I think the first thing is really about education, right?
Exactly. Starting with some solid resources can make a huge difference. I'd recommend checking out books like The Book on Investing in Real Estate with No and Low, Money Down by Brandon Turner. It's really practical, especially for folks looking to leverage 1031 exchanges.
That sounds like a great read. And there's also the Bigger Pockets podcast. They cover a ton of real estate topics, including 1031 exchanges.
Right, the conversations there are super relatable. You can learn from others' experiences, which can help you avoid those costly mistakes.
So, what about tools? I know there are some apps that can help streamline the process.
Definitely. Tools like Zillow are fantastic for research. You can analyze market trends, property values, and even find potential investment properties.
And what about the Bigger Pockets calculator?
Yes, the Bigger Pockets calculator is a great tool to help you analyze deals. It's user-friendly and really helps you see the numbers clearly, which is crucial when considering a 1031 exchange.
And then there's Deal Check, right?
Exactly. Deal Check is another good one. It lets you evaluate properties and run financial projections quickly, which is super helpful when you're in that decision-making process.
And we can't forget about Rentometer. That's another useful tool for gauging rental prices in various areas, right?
For sure. Knowing what you might earn in rent can be a big factor in your decision.
All these tools are like having a personal assistant for your real estate journey.
And speaking of personal journeys, I think it's important to start small. If you're feeling a bit overwhelmed, why not commit to analyzing just one deal a week?
That's a really manageable goal. Just one deal a week can build your confidence and understanding over time.
Exactly. And joining a local real estate meetup can also be a game changer. You get to network with others, share experiences, and learn from those who have been in the game longer.
Yeah, surrounding yourself with like-minded people can really motivate you to take action.
And don't forget about local MLS access. If you can get access to the multiple listing service, you'll have a treasure trove of data at your fingertips.
Right. Having that kind of information is invaluable, especially when it comes to making informed decisions.
And another habit to consider is setting aside time each week to review your goals. This could be a monthly check-in to see if you're on track with your investments.
That sounds really constructive. It keeps you accountable and helps you adjust your strategies as needed.
Absolutely. And remember, it's okay to start where you are. Everyone's journey is different, and taking small steps can lead to big changes over time.
Yes! And sometimes just having that mindset shift can be really empowering.
So those are some practical first steps. Now let's bring this all together. So as we wrap things up, let's just highlight a few key takeaways from our chat about the 1031 exchange mistakes to avoid.
Yeah, that sounds great. One big takeaway is definitely to really do your homework on the properties you're considering. I mean, it's easy to get caught up in the excitement, but due diligence is crucial.
Absolutely. And then don't underestimate the importance of timing. You know, the deadlines can be tricky. Missing a deadline can really derail your plans, so you want to keep a close eye on those.
Right, and another point we touched on is the whole idea of not consulting with professionals. Working with a good advisor can save you a lot of headaches down the line, right?
For sure. And let's not forget about the tax implications. Understanding how those work can really make a difference in your overall strategy.
Yeah, it's all about maximizing your investment. And, as we mentioned, mistakes can be costly, but they're also learning opportunities if you know what to look out for.
Exactly. Building wealth through real estate isn't just about making the right moves. It's also about learning and adapting as you go.
And speaking of moves, if you enjoyed today's episode, don't forget to like, subscribe, and comment on your biggest takeaway, or any questions you might have.
Sharing is caring. So if you know someone over 40 who's thinking about investing in property, send this episode their way. You never know how it might help them out.
And next time, we'll dive into refinancing rentals with the BRRRR cash-out method. It's going to be an exciting one.
Yeah, I'm looking forward to that.
Well, thanks for tuning in today, everyone.
We really appreciate you spending this time with us.
Until next time, take care and happy investing.
Bye for now.